investors. Do you note if interest rates go longer for higher and higher for longer, which of the REITs will become more and more vulnerable? In fact, I was interviewed in Lianhe Zaobao last week on essentially what are the criteria to look out for so that you can identify those REITs. We actually mentioned a couple of REITs there, but based on the three criteria I've enumerated, one is the fact that going into this interest rate upcycle, which are the REITs that have prepared their REITs balance sheet well by actually de-gearing as opposed to achieving higher gearing ratio into this upcycle. Two is, are their cash flows probably well prepared, like adequate interest cover? Favorably is actually a higher interest cover. Of course, the ones with lower interest cover, then you know these are the more vulnerable. And thirdly, the other condition is the cost of funds. Are those REITs facing huge cost of funds jump? Either the banks is not supporting it, or they have not been able to um, structure their loans into fixed term loans in terms of proportion, you know, before the interest rate upcycle actually goes up. So once again, in this week's video, this is what we're going to analyze in detail. Subscribe, and smash the like button, and then so that you'll be notified for all our future REIT investment videos, so you'll be updated to help to protect your wealth. So, my fellow investors in real estate investment trusts, which REITs now going forward will be more vulnerable as interest rates are going to go higher and for longer? In my Lianhe Zaobao interview last week, this is what I have mentioned. I've used three criteria to gauge and pick out those REITs that are more vulnerable. One is higher gearing ratio at the time when REITs are going into a higher interest rate upcycle. Now remember, as investors, we pay the managers to actually manage properly. So the management of REITs should be in a position to be able to gauge that interest rates are going up. Maybe you may not foresee it's going higher for longer, but you must take corrective action before that. And one of the ways is to have lower your gearing ratio before that. Two, to have sufficient interest cover. Some of these REITs that I've mentioned, like Suntec and Elite, have actually seen an erosion in the interest cover. And thirdly, we look at some of the REITs which are slapped with higher cost of funds, for example, like Manulife REIT and Prime REIT. So in this week's video, this is what, gentlemen, when REITs enter into an interest rate upcycle, as the last two have seen, that is actually the last two interest rate scenario in 2004 to 2006 and between 17 December 2015 to 20th December 2018. It is very highly predictable that REITs that did not prepare well for the interest rate upcycle will be smashed very badly. So in this case, it is not surprising based on the 1-year data of Manulife US Real Estate Investment Trust. Now, how have they performed? If you look at the blue bar, you can see that the share price have tumbled. In fact, tumble is a poor adjective. It has crashed by as much as 45% in the last 1 year, right? This means, therefore, simply that if you have invested $1 million in Manulife, your share price or your share value on your net worth in Manulife REIT now is only worth 550,000, down by 450,000. That's a severe ouch. Now, what about, you may say that, oh, interest rates increases, therefore REITs will suffer. True. In the last interest rate upcycle between 2015 to 2018, as I actually have shared and pieced and detailed in my book, Making Your Millions in Real Estate Investment Trusts, REITs basically lose an average 22%. But you can see that if you pick even in the right sector, right, the better REITs, then you will notice that, for example, Keppel REIT is also doing office, and they have offices mainly in Singapore as well as Australia. You will notice that they have performed so much better and Manulife REIT. Yes, it is down by 10%, but it's actually outperformed the FTSE REIT index. And certainly compared to Manulife, it has really outperformed Manulife in a big, big way. Once again, this is also mentioned and predicted in my book, Making Your Millions in Real Estate Investment Trusts. Now, one of the key things, why were we able to pick out, and advise our investor students to stay away from Manulife REIT for the last 2 years? In fact, in my book, Making Your Millions in REITs, I've actually mentioned that Manulife will see, 55 cents. There's a fall of more than 40% when I first wrote the book way back in 2019. Yes, we had been able to foresee that in 3 years before this phenomenon happened. How will we be able to do that? Is that we track, for example, its gearing ratio, we track, for example, its interest cover, we track, for example, its cost of funds, as well as basically how the manager has actually instituted the acquisition policy, whether it's actually in sync and in favor of minority shareholders like you and me. Now, in Manulife's case, it's very clear that at the end of 2021, the gearing ratio was 36.3. So instead of coming down and preparing the REIT to face higher interest rates environment, you can see that the REIT now faces a higher interest rate environment with higher gearing ratio instead of lower gearing ratio. If you notice that for Capital REIT's case, it's just the opposite. So what's in the share price that is unusual. It is something that you and I could have easily predicted. Further, in fact, compared to the digital core REIT, which used to be the worst performing REIT year to date, now Manulife REIT has fallen further, and now it's down 41% year to date this year. And you can see its market cap has shrunk down to 721 million. And then you ask yourself, how is the market cap of Manulife at its IPO? It was above this figure. And don't forget that they actually raised close to 400 million in new funds, which means that since its IPO, the new funds that were raised, the value have practically been wiped off, right? So picking the right REITs into your portfolio to grow and consistently grow your portfolio and your wealth is key in generating and making millions in real estate investment trusts, as I actually detailed in my book. So, well, the other thing that why were you able to do that is because, or foresee this, is because like in this annual report from Manulife, this was actually published in 2018, right? Mind you, my book was written just after that, and in my book I've shared that I was able to actually or advocate a warning on Manulife is because one of the key things that we actually look for is the fact that if the REIT says they are poised for growth, we would actually like to find out where and to what extent is this actually valid, right? So what happened is that in the years ensuing, that's 2019, 2002, well, that so-called poised for growth have come into question. Even in the latest set of results, that Manulife has presented, you notice that in one slide alone, they have tried to show you so many, indicators, that seems to suggest that the worst is over. It seems to suggest a strong recovery momentum, but in our global GCP global annual or rather quarterly REITs classes, for the last 3 years already, we have been mentioning that this so-called green shoots. Now we would like to see substantive evidence of that happening before we will actually change our tack and our call on the REIT. But so far this has not happened, and true enough, by actually avoiding Manulife all these years, we have managed to save investors a lot of money. So for more, ladies and gentlemen, do come to our YouTube video, which we post every week. Do smash and subscribe to our channel, and also to be notified, of the latest video, as we bring you the latest in real estate investment trust to help protect your wealth as we go through this interest rate upcycle. So this is basically EC World REIT and versus Ascendas REIT, both in the industrial sector, but you can see the fortunes are very, very different. As EC World REIT, the share price is down 34%. Right? This is actually enumerated by the blue bar, right? Okay, so it's down 34% in the last 1 year, as compared to its competitor Ascendas Real Estate Investment Trust, which is basically one of our core holdings that we have been recommending in our quarterly REITs investment classes. It's only down 9%, outperforming the FTSE REIT index. Now, how were we able to suss out such different comparisons? Because we look critically at EC World REIT. While you can see that its gearing ratio did not actually increase substantially more, whereas Ascendas REIT has been able to stay close and constant at 2.1%. You can see that essentially, if you look at the interest rate faced by EC World REIT as given here, you notice that they have both onshore and offshore debt. Okay, and one of the highlights that we have mentioned in our classes is the fact that we expect that the onshore debt, because of the problems in the property sector caused by the collapse of Evergrande, you notice that the onshore debt costs for China property developers and REIT owners have gone from just below 5% now to above 6% in the course of the last 1 year. This was one thing that we were able to warn and analyze and forewarn to investors more than 1.5 years ago in our REITs investment class. And true enough, we have been able to help protect wealth in this sense. Now, once again, ladies and gentlemen, if you look at the top 10 performing REITs for the first 9 months of this year, okay, you'll notice that essentially they are still winners. Not all are losers, but if you look through all these REITs which we covered in detail in our investment class, you'll notice that essentially many of them were able to outperform better because on the three virtues that we have mentioned, that is actually the interest cost element, the gearing costs, as well as the cost of funding element. Right? So for more, and to know which are the REITs that are more vulnerable as interest rates go longer or higher, do join us for our class on the 26th November 2022. We have extended our early bird special to the middle of this month, so go on to our website and sign on quickly. We are delighted, ladies and gentlemen, that the CITIC Media has actually come in to actually support us and help us publish our Chinese edition of our book, which is now sold in China and US and Europe. Okay, so you can see, ladies and gentlemen, that essentially we're catering a lot these days to a lot of family offices, ETF funds and index funds, as well as ultra high net worth individuals. That's because many of them do realize that you can actually generate wealth through real estate investment trusts. Is what we do. And you can see that we regularly meet up with REIT CEOs. For example, the latest is actually with Cecilia REIT CEO, Ms. Cecilia Tan. And then in our classes, we share what we find so that you are actually in the best position to help protect your wealth as you go forward. So as in our Business Times interview, we basically think that there should be better investor education to protect you and to protect your wealth going forward as interest rates go higher. So till next week, ladies and gentlemen.